Hi, accounting class. It's another great day to do accounting. We're looking at today chapter 12, statement of cash flow. Before we get started with this, I'd like to warn you that even professional CPAs grumble when they have to create a statement of cash flow. So this is going to be a challenging concept at first. In addition to that, when I was a Principles 1 student many years ago, I didn't completely have this mastered. I'm a CPA now, so it's okay if you don't have this completely mastered, but I do want accounting majors to see it at least once to have a basic framework because you are going to see it in intermediate accounting. So it is one of the basic 4 financial statements along with the balance sheet, the income statement, the statement of retained earnings. It's cash, like we focus on this accrual basis of accounting throughout all the other chapters. And remember, accrual basis revenues are revenues when earned, and expenses are expenses when incurred. But cash is still important. You still need cash to effectively pay your bills, to expand operations, and to pay dividends. And some analysts are people who looks at stocks and tries to get to a value of the stocks, which stocks to buy, which ones not to buy, etc. So some analysts would argue that operating cash flow is just as important as net income. And we're going to see this operating cash flow in the statement of cash flow later. All right, I've separated this. I've approached it as a how-to guide at first, and later I'll explain why we did each step. So at first it's just going to be a how-to guide with rules to follow to create a statement of cash flow, and later we'll look at why we executed each of those steps. All right, first most important thing is it has 3 sections. The first section is the operating section. The second section is the investing section. And the third section is the financing section. So 3 different sections to the statement of cash flow. It's easier to start kind of at the bottom. Financing activities will be debt and equity transactions. So buying bonds, selling bonds, issuing bonds, buying bonds back. Those type of transactions are equity, issuing stock type transactions, or paying a dividend will also go in this financing. So we think anything related to debt or equity transactions. For the investing section, think about selling fixed assets or investments. We didn't talk much about investments in this course, but they would also go in this section. But mainly focus on fixed assets. We're not going to see an investment in the problems we're doing. All right, everything else will go then in the operating section. So operating section has all the day-to-day type operations of a business. So selling products, buying inventory, all those type of day-to-day cash transactions. But it's easier to define financing as debt and equity, investing as buying, selling fixed assets, then operating will be everything else. So we got a picture of some cash here. That's what this chapter is about, statement of cash flow. All right, so we're going to have the 3 sections. This is the how-to guide. I have a lot of information on one page here. We have basically the whole how-to guide to create a statement of cash flow. All right, the first section is the operating section. Operating section. I'm going to call it later in the notes OCF. What section we're going to put it in? OCF, it stands for operating cash flow. So it would go in the first section, which is cash flows from operating activities. All right, we're going to use the indirect method here. The indirect method is called the indirect method because we start not with actually cash coming in or cash going out. We're going to start with net income. So it's called the indirect method. There's also another one called the direct method, but it's used by less than 1% of companies because it's costly to get the data. It's not usually readily available for a company. So we're using the indirect method. It's called the indirect method because it starts with net income. So that's our starting figure. We're going to start with net income, and we're going to adjust it for revenues and expenses that do not involve the receipt or payment of cash. All right, so we're going to start with net income. Net income will be our first number. Here are the adjustments we're going to make. The first one is always to add back depreciation. Depreciation is a non-cash expense, so it reduces net income, but it didn't require a cash payment. So if we're starting with net income, trying to get to our cash figure, we're going to add it back. This is true for all the other relatives, I call them, of depreciation, like amortization and depletion. All 3 of them fit in the same category and would be added back. The second adjustment is to look for any gains or losses on the sale of fixed assets. So the gains and sales on sale of fixed assets will have a cash effect. The reason we want to undo their effect here, though, is because we want those cash flows to go into the investing section. So we want to back them out of the operating section. So they would appear in net income. We want to back them out or undo their effect, because we want all the cash flows to go in the second section, this section down here, cash flow from investing, because they're related to a fixed asset. So this means we're going to add back any losses. Losses subtract, so we're going to add them back, and we're going to subtract any gains. Alright, the remaining adjustments, they rely on something called a comparative balance sheet. A comparative balance sheet we're going to see on the next page is a balance sheet that has more than one year on it. So at least 2 years on it. On the comparative balance sheet, here are these simple rules. We'll make sense of them later, but here are the rules. For non-cash current assets, so we're not talking about cash because the whole report is going to explain cash. We're just talking about non-cash current assets. So current means something that's used up or usable within a year. 1 year is the cutoff for current asset. If it's beyond 1 year, it's a long-term asset. But for the non-cash current assets, we're going to do the opposite of what we think, the opposite of the direction of change. So if a current asset, let's take AR for example, if it increased, we're going to do the opposite of what the increase is. We're going to deduct it. On the other hand, if AR decreased, we're going to do the opposite of it, and we're going to add it back. Now these rules are the same for all other non-cash current assets, right? So for non-cash current assets, we're going to do basically the opposite of what we think we would do, right? So if it decreased, we add it back. If it increased, we deduct it. All right, on the other side of the balance sheet, we have current liabilities. Current liabilities, we're going to basically move in the same direction of the change. So we're going to do exactly what we think we would do for current liabilities. Current liabilities will be accounts payable, wages payable, things of that nature. So we're going to take accounts payable. If it increased, we're going to add it. So we're moving in the direction that we would think. An increase, we think of a positive number, so we add it. AP, if it decreased, we're going to deduct it. And these rules are the same for all other current liabilities. Alright, if we add up all these numbers starting with net income plus all these adjustments, some of them may be negative, so the net effect of all of it, but we would just basically sum up all the numbers of these adjustments with net income, and we'll get to the operating cash flow section, or the total cash flows from the operating section, which is one of the 3 sections. The next 2 sections are a lot easier. The operating cash flow, we cover the tough part here with the indirect method, because it starts with net income and adjusts it for revenues and expenses that do not involve the receipt or payment of cash. Alright, if we receive cash from the sale of fixed assets, it's going to go into the investing section as a positive cash flow. So it's just the direction. If we're receiving cash, it's positive cash flow. If we paid cash for the purchase of a fixed asset, it's a negative cash flow. Alright, the total in this section will be equal to the cash flows from investing section. So that would be the second one. We had the first one, the operating section, now that would be the total of the investing section. Alright, if we received cash from issuing stocks or bonds, so we issued them, we're going to receive cash, and therefore it's a positive cash flow. On the other hand, if we paid cash to repurchase stocks or bonds, or to pay a dividend, it's a negative cash flow. The total in this category will equal the cash flows from financing activities. So this will be the 3rd section. Alright, the 3rd step here will be to reconcile the cash balance on the report to the balance sheet. So what we're going to do is add up 3 sections, the operating cash flow, plus the investing cash flow, and the financing cash flow. Add up those 3 numbers, we get to the total change in cash. So it's the operating plus the investing plus the financing will give us the total change. Then we're going to take beginning of year cash, which will be on the balance sheet, plus the change in cash that we just calculated, and we'll get to end of year cash on the report. All right, let's go and see a problem. Here we got Tony Strucking. They had net income of $25,500. This is going to be our starting point for the operating cash flow section. In addition, the comparative balance sheets below, blah, blah. Here's a comparative balance sheet, so it has 2 different years. All right, other information given in the problem. What we're going to do is take that information and decide what section it goes into. Remember the 3 sections: operating, investing, financing. The amount that's going to go in that section, and the direction, i.e. a positive cash flow or a negative cash flow. All right, depreciation expense for the year was $28,500. So this is going to be added back. Remember, it's our first adjustment to net income, so it's going to be added back to net income in the operating section. So I put OCF, meaning operating cash flow. We're going to add back the $28,500 because this is a non-cash expense. So it deduces from net income, but it doesn't require the payment of cash. So we're going to add it back to net income if we're trying to get to the cash figure. Equipment costing $42,500 with accumulated depreciation of $32,500 was sold for $7,500. Let's get a calculator. 42,500 minus 32,500 equals 10,000. So its book value is 10,000. We sold it for 7,500. That means we sold it at a loss, right? 2,500. I don't know why it took me that long to think of it. So we should have a loss of 2,500. We're going to add that back to the operating section. Because remember, we want the cash flow, the total amount of the cash flow for this transaction to appear in the investing section, not in the operating section at all. So we're just going to undo the effect. The loss subtracted from net income, so we're going to add it back. We're starting with net income, trying to get to the cash amount. All right, equipment costing $62,500 was purchased for cash. Okay, wait, we got to go back. There's another one for the second one. Right here, the equipment costing $42,500 was sold. We got a positive cash flow of $7,500 in the investing section. So ICF is the investing cash flow. We got a positive cash flow of $7,500. All right, equipment costing $62,500 was purchased for cash. So we're going to have an amount in the investing section. $62,500, and it should be a decrease or a negative cash flow. Common stock was sold for $16,000. Alright, common stock. Where we're going to put it? Third section, right? The financing. So financing cash flow, it's going to be a positive figure because we're receiving the cash if we issued common stock. Paid a cash dividend for $6,000. It's going to go into the financing section as well because it's a payment to the equity, to the shareholders. It's going to be to financing cash flow, and it's going to be negative because cash going out of $6,000. So that's all given by the problem. There's additional steps. These are not going to be given by the problem, but they're just additional steps that we're going to think about. The first step is to identify non-cash current assets. Non-cash current assets. And then current liabilities. So identify non-cash current assets and current liabilities. Let's go and do that real quick. Non-cash, so we exclude cash. We're going to think accounts receivable at its net value, net of the allowance is what that means. Inventories. Alright, that's 2. And then on the current liability, we have accounts payable. Alright, so we've identified them. It says to ignore dividends payable. These cash dividends payable is technically a current liability because it's going to be paid within 1 year. But we're excluding them from highlight here because they're going to be in the third section, not in the operating. The first section is the operating cash flow. They're not going to be in the operating section. They're going to be in the third section, the financing section. Alright, so for the 3 that we have highlighted, we want to calculate the change in the account. How it changed. So year 2 minus year 1 amount. Year 2 less year 1 amount. So year 2, 39,000 minus 42,500 is going to be a decrease of 42,500. For inventories, year 2 is that 50,750 minus 45,000 will be a positive 5,750. Accounts payable, year 2 minus year 1. Change. Alright, the next part we're going to decide, it's going to go in the operating cash flow, but like what direction is the question mark for? Is it going to be positive or negative? And what I want you to do in your mind is erase the negative signs here. I'm leaving the negative signs here to show it was a decrease, but I don't want you to think of it as having negative numbers anymore. It's just a positive 3,500 that happened to be a decrease. Alright, so the operating cash flow, what are we going to do with the 3,500? Remember, move in the opposite direction of the change. The opposite. This is a this has parentheses, so a decrease, so we're going to add it back. This is what I mean. We're going to add back 3,500. We're not adding back a negative 3,500. We're adding back 3,500 itself. So make sure you erase the negative signs in your mind for this approach. For the 5,750, what happened to it? It increased. For current non-cash current assets, do the opposite. Since it increased, we're going to subtract it or deduct it. For accounts payable, it increased. Remember, accounts for current liabilities, you're going to do kind of what you think. So this one increased, so we're going to add it. Alright, now we have all the information we needed to start this report. This is going to be reported as a typical 3-part title. Tony's Trucking Incorporated, Statement of Cash Flow at December 31st. Alright, we're going to start with the first of the 3 sections, the cash flow from the operating activities. Alright, remember this approach starts with net income. This problem gives us net income at the start of it. We go back up, let's see, the net income was 25,500. Alright, I think we're going to start doing some of the adjustments. I would always encourage you to think about depreciation first, adding it back. Well, we got a label for adjustments. I bet depreciation's here. Yep. Depreciation, what was depreciation in this problem? 28,500. Alright, next we would think about any gains or losses on the sale of fixed assets. Remember, right here, we had a loss of 2,500. We're going to need to add it back. We've already did, because we're going to undo the effect of the loss. The loss normally subtracts. We're undoing its effect, so we're going to add it back. So we'll see a positive 2,500 for it. Reversal of the loss. All right, the rest of it should be the comparative balance sheet. We're going to add 3,500 and subtract 5,750. And later we're going to see we're going to add 1,750 for AP. So we should see those 3 next. These 3 are going to come from the comparative balance sheet, which we already discussed. This one's a decrease in accounts receivable, so we're going to add it back. The increase in inventories we're going to subtract out, and the increase in accounts payable we will add. Alright, we should be able to get to our first big number now, which is the cash flows from the operating section, which is just a summation of this entire row. So all these numbers added together equals the net cash flow from the operating section of the statement of cash flow. We're going to move on to the investing section. Alright, the investing section, let's see what went to ICF. We have a positive cash flow here for 7,500 and a negative cash flow for 62,500. So we're going to list both of these ones that say ICF. Those are the only 2 for the investing section, so we're going to add or net these 2 numbers together. By netting, I mean 7,500 minus 62,500. And we'll get to the net cash flows from the investing activities. We have one more section to do, cash flows from the financing section. So let's see what we put into the FCF. We had a positive 16,000 for the issuance of common stock. And we had a negative 6,000 for the payment of dividends. Alright, we'll net those two together and we'll get to 10,000. Our next step is to add up the three different sections. So we're going to net together these three numbers. So it'll be 56,000 minus 55,000 plus 10,000. To the total increase in cash. And now we're just going to go to the balance sheet and get the two numbers for cash. It started at 39,000 and ended at 50,000. Look at this, it should tie out, so the 11,000 change plus the 39,000 does indeed equal to 50,000. So this gives you an example of the statement of cash flow. The other example I have in here, we're going to go through the page of why we did each step real quick. Alright, why do we start with net income for the operating section? It's just the method that we choose. It's called indirect method. It's used by about 99% of companies. Only 1% or less use this direct method because the direct method normally requires information that's not readily kept by a business. So it's more costly to gather or pay people to gather. Alright, why do we add back depreciation? It's just depreciation is a non-cash expense, meaning it's an expense. It lowers net income, but it didn't require a cash payment. So it's a non-cash expense, so we're always going to add back depreciation. Depletion and amortization, the other relatives of it, would be treated the same way, but we didn't see an example of it. Alright, why did we add back the loss on the sale of fixed assets? So gains and losses may affect cash, but the cash flows related to fixed assets are shown in the investing section, so we want to undo their effect. So whatever effect it had, a gain adds to net income, so we deduct it. A loss subtracts from net income, so we add it back. We undo the effect. What is a comparative balance sheet? It's just a balance sheet that shows more than 1 year of a balance sheet, so at least 2 years. It's useful for calculating the changes in accounts between 2 or more periods. What is a non-cash current asset? A current asset is one that will be used or usable with 1 year. So cash, accounts receivable, supplies, prepaid insurance, stuff along that line. Alright, non-cash means we're going to exclude cash because that's what the whole report is explaining. What is a current liability? Why did we ignore dividends payable? It says a current liability is a liability due within 1 year. Dividends payable is a current liability, but we're going to report it in the financing section. Because it relates to equity. Alright, why did we move in the opposite direction of change for a non-cash current asset? What we're going to do here is consider AR. That's an example. So assume we made one sale of $100 near year end that hasn't yet been collected in cash. That $100 would increase sales because we've incurred it already, but it doesn't result in the collection of cash. So therefore we should subtract it. So it affected net income in a positive way, but it didn't affect cash, so we need to back it out if we're starting with net income and trying to get to the cash amount. Alright, why do we move in the same direction of change for current liabilities? One way you can think about this is that current liabilities are the opposite of current assets, right? So they're going to have the opposite rules, and that's what we see here. Current liabilities are just the opposite rules for current assets. But we can consider an actual example here. Let's consider accounts payable. So let's consider accounts payable. Assume we made one purchase of a $100 expense. It was made on account and hasn't been paid as of year end, so it's still sitting in AP. The $100 expense, if it's already been consumed, will reduce net income, but it did not require a cash payment. So it reduced net income, but didn't require a cash payment. Therefore, we should add the $100 back. Alright, that's it for the statement of cash flow. This one's a much more challenging one than the effective interest method. This will be your last priority for accounting majors. I recommend just viewing this video a time or two and getting at least a little familiar with it, so that way when you see it intermediate accounting, it helps you there. But it's not something you should really stress out to learn and to master at this point. But I do want you to at least know it exists and kind of the format of it, so it's easier for you when you get to intermediate accounting. Alright, I'll see you guys next time for the next video. Take care. Bye bye.